I mentioned that new note from market technician Jonathan Krinsky, dropped just moments ago, joins us now on the phone. They ran the note out to me, said he just put one out. I said, well, we got to get him on. Welcome back.
Good to be here, Scott. Thank you.
The headline is, don't buy this dip. But why?
So the hallmark of this market this year has been this constant internal rotation that kind of insulates the S&P, right? So interest rates drive a lot of that. And, when you have a day where rates are lower, you tend to see the NASDAQ and tech names do better, and banks and cyclicals do worse, and then vice versa, that flips. But we're starting to see that kind of lose some of its luster. We're seeing the weak areas of the market remain weak and even get weaker. So we're talking about, the K-Web, China Tech, the ARK funds, the SPAC. So those are areas of the market that, typically have seen decent rotations, throughout the year. But the last few weeks and even the last couple of months, really, they're just not responding to the upside like they have in the past. And then we all know about the small caps, and we've been giving those the benefit of the doubt. They've been in a 7-8 month consolidation, and typically those resolve in the direction of the underlying trend, which in this case would be to the upside. But if you look at the internals of the small caps, even as they've gone sideways, internals continue to break down, and that's typically a sign of distribution. So, when the weak areas of the market remain weak and get weaker, it leaves fewer and fewer names to do the heavy lifting, and we know the names that we're talking about. It's you talk about them every day.
Well, they continue to do the heavy lifting, though, right? I mean, I hear what you're saying, but as long as those names, like, Apple hits another new high today, I'm presuming you're talking about Apple among some other names. As long as those stocks hang in there, then the overall market resists this larger pullback. It's sort of the idea of the rolling correction having yet to really impact the biggest stocks in the market. And until that happens, you're kind of on okay footing, even with some turbulence mixed in.
Well, this really comes down to, what type of investor you are. If you're a passive investor in the S&P 500, then you just need to watch, 5 or 6 stocks. And, as long as Apple and Microsoft and Google are trending higher, then the S&P is pretty well insulated. The issue, again, though, is that most people are not just in the S&P 500. Most people are in a more broader, diversified portfolio. And a lot of those stocks, again, are not seeing the rotation that they have. And, in fact, they're actually getting weaker. And, I'll use the Chinese tech names for one example. They're oversold and they can't bounce. And, some of the biotech names, XBI, similar situation. It's been weak, and we ourselves expected them to get a bounce, and they just can't happen. So basically what happens is when weak stocks get weaker and the market's increasingly reliant on fewer and fewer stocks, on the one hand, it makes breadth less relevant to the S&P 500 because those names represent a bigger portion of the index. But on the other hand, and you saw it yesterday morning when Apple went from green to red on the day, it took the whole market down with it. So it's kind of a paradox in that, yes, it matters less until it matters. And right. I think the dip yesterday was interesting because dip buyers were rewarded when they bought the dip yesterday morning. But then today they come in and they're basically underwater on those buys. And I think, that could be the start of a little bit more of a meaningful correction here. I
mean, the point decline looks worse, obviously, than the percentage loss would tell you is really happening within the market. I mean, I don't think the market likes your note very much. The Dow's down 385. But again, that's a 1% decline. The S&P 500 is down 1%. That's a loss of some 44.5 points. If you do think we're on the cusp of a bigger pullback, to what degree do you think we get it?
Well, again, if we're talking about S&P 500, we know we haven't had a 5% decline since last November. I think that's perfectly reasonable. The 50-day moving average is around 3.5% off the highs. That's around 43.50. So I think somewhere in there is a starting point. And again, as you know, calling anything bigger than that is really just a fool's errand. But I think, getting something 3.5 to 5% off the S&P, which, by the way, if that happens, there's going to be a lot of stocks that are off well more than that. But I think that's a good starting